Data comes through here in the United States. Let's whip through it for you. Initial jobless claims keep doing their thing. They grind lower and lower and lower. The reading 234 from a previous number of 233. That's a revised figure. So we come in at 234, below the estimate of 238. Grinding lower through the last 10 years, just a tick higher month on month. But that is a record if you have to go all the way back to the 70s for these kind of numbers for initial jobless claims. The advanced goods trades balance comes through a little bit wider than expected at negative $67.6 billion. Wholesale inventories month on month come in negative 0.3% from a previous reading of 0.2%. Initial jobless claims a little bit of a tick higher from the previous month, but certainly that trend, David Weston, has just been that chart that just does that, just grinds into the floor.
It's just remarkable, the employment, particularly if you go back 8 years or so to think where we were and where we thought, boy, we were really in trouble. Yeah. And now it's extraordinary what's happened in employment in this country. So we want to talk about these numbers and what they really tell us about the U.S. economy more broadly. Ebrahim Rahbari of Citibank is still with us, and we're joined now by Bob Miller. He's portfolio manager for the BlackRock Total Return Fund. Welcome to the program, Bob. Good to have you here.
Thanks, David.
So I mean, taking these numbers that we have just come out, put them together with the Fed minutes yesterday that talked about the fact that inflation continues to be fairly low, really restrained, and yet the employment situation, it's very high employment with very little wage pressure. What do you make of all that? How do you put those three things together?
Yeah, I think the labor market indications continue to suggest a very robust labor market. I would argue that we're at full employment. We've achieved that. If you adjust the unemployment claims and the continuing claims for the size of the labor force, the insured unemployment rate is the lowest it's been in 50 years. Right? So, labor market's fine. Inflation is a more nuanced discussion. The 20-year average annual change in core PCE is 1.66%. The range of year-over-year changes in PCE inflation over the last 20 years has been between 1% year-over-year and 2.4. We're currently at 1.6% year-over-year, with the next reading next week likely to print 1.5. So we're around the average. I would argue that the Fed has achieved stable inflation, which is part of its mandate, and it's a little lower than the majority of the Fed, or certainly many members of the Fed, would like. But it's important to keep in mind that there are a number of negative contributors to inflation, core and headline, that are outside of the Fed's control, specifically the technological development and innovation that continues to deliver to consumers more and more goods and services at ever lower prices. That's not a negative inflation or deflation fundamental.
So is that accounting for the restrained inflation in part? And does it go even further than that and perhaps account for some of the relative lack of wage pressure as well? Is technology really affecting that?
I think it definitely plays a part. So I'm on the same page as Bob. I think it's a very significant factor, more significant than in the past, even though there's a big debate about it. And I also agree with Bob that we have to be somewhat humble when it comes to trying to fine-tune inflation, exactly at 2% or so. And I think the Fed has a bit more leeway than other central banks because it doesn't have that clear primacy of the inflation goal. But it isn't entirely straightforward to associate all of that softness in inflation to innovation specifically and directly. It's very hard to find hard empirical evidence that ties the two together.
So, Bob